So we know trading earnings, it's an event that comes around 4 times a year. We know that there's more volume around earnings, more volatility, and more uncertainty. And these are things that can create trading opportunities. So when you do trade earnings, when you're trading an earnings strategy, really the most common questions are, well, how do you find trades with the most profit potential, right? What are your entry and exit points to use? And how do you evaluate a strategy, right? So even though in earnings, you could look up on the calendar, you have a list of all these stocks, but how do you decide what to do? Where are the best opportunities? And then we'll discuss these 3 questions.
Sure.
And before we get into even that, I kind of want to set the framework, because I think that when you trade, you want to set yourself up to be successful, and there's certain things you have to kind of think like a trader, or even when you're trading, you have to approach it like a business, and you're in the business of risk. I think we talked about it before, but
Sure.
I just kind of want to reiterate it, and I'm going to probably use my MS Paint today, to show some illustrations. But
actually, let me cut you off right there, Dmitry. While we're talking about risk, I forgot to bring this one up, guys. We are absolutely not telling you what to trade. We're giving you some ideas, talking about strategy, but you all have to be careful. This is your money if you're trading. We are not telling you what to do. You got to do your research. If you don't know what you're doing, please do not trade. It is absolutely risky. You can and will lose money trading. You have to be prepared for that. We're absolutely not telling you what to do. So there's a disclaimer, everybody. Just be careful out there. Sorry to cut you off there, brother.
No, that's fine. And it's a good point. And I think when I talk to people about risk, and I try to listen mostly, and I do see that sometimes people think they talk about risk and they understand it, but it's a lot different if you never ran a business or had investment portfolio. The concept of profits and losses, it doesn't sink in as much as like somebody who's had a business before. So if somebody works and gets a paycheck, and their thought process is, well, I put in this work, I'm owed money at the end.
Sure.
But when you're running a business, when you're doing investments, it doesn't work that way. It's about profits and losses. You're going to have both. Everybody, any business has both profits and losses. And your goal on average, right, is that your profits should exceed your losses, right?
Sure.
That's how you make a profitable business. You will have more profits that will offset all your losses. And I'll explain that and even illustrate it as what a business might look like. So, and losses, they're unavoidables. And what I mean by that is, this is what I'll typically see people
do. I lost you for a sec, Dmitry. Why don't you share your screen again there? Make sure it's shared. We lost your screen for a second there.
Sure.
By the way, Joe, thanks for joining. Oh, Joanne. Okay. But remember, guys, sorry, I got dogs. It's midday here in Costa. we got wild animals running free. Apologize for that. But remember, guys, I saw a bunch of people put like where they're from in the question section. Remember, that's in the chat. The question is for questions to Dmitry about about options trading or earnings or whatever. So there we go, Dmitry. I got it back up for you now.
Okay. Do you see everything?
Yep.
So I'm just going to show you kind of like what I think people are doing. And if you could understand this concept, it's very important to be successful. So I'm just going to do like a quick illustration. When people start trading, they say, okay, I see, I'm going to make profits and losses. So my goal, they think, is to trade to avoid these completely, right?
Yep.
I just want profits. I want to completely avoid this. That's what they think their goal is.
Sure.
But this is not practical. You're in the business of risk. You're going to have profits and losses. You're going to have positions. If you're doing it right, you're going to be on the right side of news and big moves, and on the wrong side, right? You're going to be, your goal is though to manage something in between there, but we'll take a look. But if you're doing it correctly and you're dispersing your your bets, there's going to be unexpected news, right? There's going to be something tomorrow might happen that you always cannot predict.
Bernie Sanders hits you with a tweet and your company goes down 5%. It just happens.
Exactly. Yeah, that's going to happen. And you should be, over the long term, you should be on, if you're dispersing your bets, you're betting small, those situations should offset themselves. But you're trying to avoid these, but it's not possible. It's not possible to just have winners. It's not possible in business. It's not possible in trading or investment. Even if you look at Warren Buffett, I could give you examples. Sometimes he buys, I think he bought Apple stock 2 times in a row, just went right against him immediately. And he had losses. Even if you take the best people on the street, like take Knight Capital, they had a catastrophic loss. Citadel. Look at the big banks like Lehman. Bear Stearns. Something is going to happen. Something is going to happen that they just took too much risk, which they thought something was 100% guaranteed. Goldman Sachs needed a bailout, right? So even the best on the street.
Mike says it, an old Texas expression. If you're not losing lures, you're not fishing.
Yeah. Right. Yeah. And you're not, it's already known, if your account has if you did 35 trades and there were 100% winners, your account will get flagged. You might be doing something illegal.
What's happening?
The brokers have it. Right. So you have to realize you're in the business of profits and losses, right? And these are unavoidable. So people, what I see is when they have a big win, by chance news comes out, they think they did it. That they were smart. Like the news came out, it was in their favor. Nobody knew about it the day before. They were smart. But if it goes the other way, it was somebody else's fault. Right?
Yeah, what was wrong? Some people, the market's an idiot. The people are idiots. How could they not see what's going on? Yeah.
Right. But this is part of life. It's even in your everyday life, you're going to have.
Dude, you can't. There are people who don't do anything, stay in one place their whole life, never take any risks, and they never get largely rewarded. You're never going to get huge wins from that, obviously.
Right. Yep. So that's important to have that in mind. You're going to have profits and losses, and we're going to go look through examples of it, and it's unavoidable. So and even unexpected or great anticipated, no matter what your analytics says, right? No matter what your analytics says, you don't know what news is going to hit tomorrow, right?
Absolutely.
You can have great historical win rates, average standard deviations. Over time, they're going to offset each other as long as you're betting small and dispersing it. But you have to have that framework, your mind, I'm going to have both. That's my business, profits and losses, and my profits have to exceed my losses. And also, sometimes what I hear is, everybody wants one analytic to tell them what to do.
Dmitry, I told you, man, all we need, our website should just be the website with one button in the middle that people just press, right? That's what everybody wants that. I want that. You want that. Everybody on earth wants that. It just doesn't exist.
It doesn't exist.
It doesn't exist. There's no way even close to that. I mean, it's infinite, right? The complexity is infinite.
It's infinite. There's a lot of analytics and statistics that tell you different things, and they're helping guide you to make a better decision, right? If you could look at, for example, everybody knows a PE, right? You have a PE ratio, but that doesn't tell you if there's too much debt, right? You'd have to look at a different ratio. Or if you look at a dividend yield, it could look good, but that doesn't tell you how much cash they have on hand. Maybe they don't have enough cash to continue the dividend. So you look at a different statistic. So you're combining statistics, to help make a better decision, but there's no one analytic or statistic. If I don't know if people out there, use Google Analytics, they have so many statistics, bounce rate, time spent on site, how many pages you viewed. You're just using them in combination, right? To see where are their problems, what's good, what's bad.
Exactly.
And when you look at statistics, when you look at a historical statistic, it doesn't tell you what news is going to come out tomorrow that could move it, right? And you might be in the middle of in the middle of news that invalidates that statistic too. Like,
Yep.
we had a situation where, in the last, year, 2 years, 3 years, this stat says, you should be bullish, buying it here, buying it there. But if the entire sector is going down, if there's news in it, the stock's going down.
Absolutely.
That is not embedded in that stat, in that historical stat. So something's changed. You have to research and look at the news, and you don't want to get long based on the historical assumptions when something's going on right now and everything's dropping. You have to consider it.
Yep.
I'll give you an example. If you're buying and selling apples, and it tells you, in February you should be buying apples because they're going to go up in price, but all of a sudden there's news, the FDA saying people are getting sick, they're going to recall the app. You have to consider, right?
All bets are off. Yep.
That all bets are off. Something's changed. You have to look at the news. You have to do a little bit more research. So I just wanted to kind of
absolutely given the base. I mean, we have a lot of. I know we have just looking at the poll, we have some definite intermediate to pros, and those guys know this. But of course, we have some newbies in here. If you guys are newbies or not familiar with the Chameleon and just trying it out, if you click on the offers tab, which is next to the questions and polls tab, you can try the Chameleon free for 7 days. And what that does is let you try all the data and analytics, make sure it works in your trading model. So there's really no risk to make sure that the Chameleon works for you. So you can click that. And remember, guys, in the questions tab, if you guys have questions that you want Dmitry to answer at the end of the show, go ahead and type them there, and we'll try to get to all those in the show. So what else you got for us, man?
Right. So right now I'm going to paint a picture of what it kind of looks like when you're running a business. I'm going to do an analogy, because we did it before. We talked about real estate, insurance companies. We talked about casinos. So let's do something different. We have here in the States, we have a supermarket, Trader Joe's. It's a supermarket. I don't know if this is known, outside of, but I'd pick, the names kind of.
Yeah, outside of the States, maybe not so much, but it's a supermarket. It's like it's like Whole Foods. Yeah.
Yeah, exactly. It's like Whole Foods. It's just a supermarket, but it's popular here. It's very good. And when you walk into a supermarket, right, here's the entrance. What you start seeing is, stuff like this. They're going to try to sell you
fruits and vegetables right at the beginning, man. Always.
Right, fruits and vegetables. Then you have like something like this. I'm just going to make it like pretty quick, and then you have like aisles over here.
Yeah.
I'm going to show you.
Look at Dmitry, man. Dude,
so
are you an architect?
I was practicing this in the morning. I even made some milk. So, you have your fruits here, right? You have your meat here. Let's say you have your bread, right? And there's a point here, but bread, I'm just making this up. Let's just say you have snacks here, right? You have your
far corner is milk, right? Always the milk.
Right. Always the milk. And then you have here like whatever, it's like pasta, all this stuff. Then over here,
I'm wondering where you're going with this, though. Where are you going with this?
Well, remember we talked about trading models, right?
Yep.
Oh, hold on a sec. Over here is the cash register. So here you have cashier, right? And then see here what's going on here. This is very similar. He's a trader, right? Trader Joe's. Why? What is he doing right? We know he's carrying risk, right? Because he needs all these goods are perishable, right? The milk, it's going to expire. The fruits. So if he's not doing it right, he's going to lose money, right? What else is he doing right? We see he's diversified, right? You don't walk in there and half the store is watermelons, right? He has fruits, meats, bread, and it will look something, his terminal, it will look something like this. He's like risking per week, $500, right? That's his risk, and he's expecting a 15% return, over time, something like that. We also see that his risk is evenly distributed, right? Like I said, you don't walk into the store and his analysis and, well, watermelons are ticking up the last 3 weeks, clear the shelves off, overload watermelon, right?
Right.
He's not doing, he's going to start tweaking things, as we'll see, but he's not doing, you never walk into a Trader Joe's and see that. The other thing is here, you have the cashier. This becomes important because this is the feedback loop. That's his data, right? So if you go into a supermarket, every time you scan something, that goes into a data bank, right?
Mm-hmm.
And that gets analyzed, right? He knows where his inventory, what is selling, what is not, right? Like, for example, he might say high demand, raise prices,
Mm-hmm.
raise prices, low demand, lower prices or decrease.
Gotcha.
Okay, so over here, his data analysis is important. It's critical to drive this whole operation. Okay, it's not going to be any guarantee, but it's going to, because he could buy. He's also he's going to be doing this. He's managing his risk. He's managing his risk, right? And it's based on collecting data and analyzing the data, right? But he knows, like, his milk. And so how is it similar to what we're doing, right? We're trading options. They're going to expire, right? We have carry risk, right? We have similar risks, right? Your milk here can expire. Here, if you don't sell it, right, you have the risk, and that's going to happen. He's probably going to have certain types of losses there. He's not going to be able to sell it in time, right?
Sure.
The meat, it's going to spoil.
Yep.
Right. Your
Vegetables go bad.
foods,
All this stuff. Yep.
yeah, they go rotten. Right. He's carrying risk right now. Right. Just like we're going to be carrying risks, he's carrying risk. Right. When you put on a trade, you're going to be carrying this types of risk. You might be a little bit different, but he's doing the same thing. Even something like pasta, if it just sits there on the shelf, it might not spoil, but eventually, if it's just sitting there, he's paying rent, he's paying electricity. So
he's probably paid for the pasta when he bought it, right? So he can't.
Yeah.
He's risking the use of
If
that
he
money,
doesn't
right?
sell it, right? If it just sits there in a year, by the time he sells it, it's at a loss,
Sure.
right? So he's managing all these risks just like we're managing, risks. But the important thing is here, right, that he's diversified. This is how yours, you're trading when you're thinking about a business,
Right.
think like Trader Joe's, right? He's not going to be overweight. He's going to be managing using data.
Right.
And then we're going to get like into examples of what he might do. So I think the first question we had was, let's go back up here. Well, how do you find trades, with profit potential, with the most profit potential? And what we're going to look here is at historicals, because if you're just looking at an options chain, I know here you have Intel coming out with earnings. You go to the options chain, earnings April 25th. Well, you're looking at these prices, but there's a lot of things you can do, or maybe you shouldn't be doing. Do a typical strategy might be, well, sell this straddle prior to earnings, wait for the news to come out, the implied volatility gets crushed. That's one strategy. Maybe do the strangle, sell this. Maybe you should be buying it. There's a number of different things that you could do here, but if you're just looking at this options chain, it's not clear, right? So you need kind of tools to help you out. Just like kind of Trader Joe, he's going to be looking at tools. Well, how much should he risk on meat, and what are his margins on meat? Maybe he risks, $1,000. His margins are 20%, something like that. So he's going to have tools, maybe which things to take off the shelves, and how to manage all this risk.
Yep.
So let's just take come back here. Now, to do that, the first thing we want to do is look at, well, what worked historically, right? Like what do we think worked historically, and start from there. Like what is a starting point? And we're faced with all these options. There's different stocks, different strategies, different time frames. And let's take an example here of Trader Joe, how he might do this. So I'm going to create a new tab here. Let's say this is still Trader Joe, right? So Trader Joe, he might also have events. We know that earnings are a special event, right? And he might also have events. So let's take a look at,
like maybe Thanksgiving.
there we go, Thanksgiving, right? So Thanksgiving, right? That might be more turkey, right?
Right. How much turkey sells the rest of the year, right?
Exactly. July 4th, you got hamburgers, right?
Yep.
Halloween. You could think he's got all these events that he has in a data bank. Summer, more ice cream, Super Bowl, more whatever, right? But he has these statistics to help him out when an event is coming. What should he be doing? He's looking at his data analytics. But let's say July 4th, let's stick with the hamburgers, and his data might say, well, on the hamburgers, if I buy them, if I buy them on, July 1st by July 3rd, let's say he makes on average 5% return, right? That's his historical. But catch-up, which was at the same time from July 1st to July 3rd, all right, July 1st to July 3rd. Oops, typing it quickly, July 3rd.
Don't worry about you typing. Hey, just want to check. Right. Is everybody seeing Dmitry and hearing everybody okay? Just because I want to make sure I'm having a little bit of a glitchiness here. I want to make sure everybody's catching the picture okay. Yep. Okay, good.
Try to move it more. Yeah, everything okay?
Good. Yeah, everybody's got you. It's just me. It's just a Costa Rica thing, man. Just a Costa Rica thing.
Okay. So I'm going to just take this one out of here. We don't need the Thanksgiving. Let's just look at these and analyze these. So how would he analyze them?
Yep.
He's got this and say, well, yeah, I could see that, the hamburgers are pretty good, but the ketchup, was even better. Or maybe something else, right? People are coming into the store and this might not even be his highest margin. So he wants to make sure, okay, he's got the ketchup. That's important information. He wants to make sure he has ketchup to sell, and whatever.
But he doesn't turn his whole store into a ketchup store, right?
He doesn't turn his whole store into a ketchup
store.
Right?
You do not do. So be careful.
Right. Right. And he's got this type of data in front of him. The other statistics. So you have this statistic. Well, what else might he want to know? Well, this hamburger, right? Let me just see if that's the example. Let's say this hamburger was from period one. He looks into his data bank, right? From period one, let's say he made like a 10% return, right? His historical. Period two.
So that's for the whole store you're talking about.
Yeah, for on the hamburger during that
on the
period,
hamburger,
from
okay.
July 1st to July 3rd, he wanted to sell out. Let's say he made a 0% return. He broke even. He had to discount him. He couldn't sell it, right? Period three, he made, let's say, 20% return, right? And then period four, he had to discount. He couldn't sell them. Let's just say minus 10% return, right? So that's right. So an average, what's that? 20%. So that's 5%. So you could see now that's more information because now we're seeing that it's pretty volatile, right? Like this hamburger, they are pretty volatile, and who knows? Look at the high-low range, minus 10% to 20%, and it's kind of all over the place. Then you might have this statistic on the ketchup and say, well, period one, let's do like a 15%. We'll do 15%, right? So period one, we'll say, let me just fix this. or
Well, Dimitri's doing that, guys. Remember, hit your questions up. We're going to get to them. I see a lot of you in the chat still. Just hit your questions in the question section. And if you're, a beginner to options, feel free to ask, because trust me, you're not the only one who's got questions. So feel free to ask questions, no matter how simple you think they are, right there under the questions tab.
period one, 16%, period two, let's say it's 14%, period three, 16%, period four, 14%. So now he has more information. Say, okay, you know what? This catch up, on average, I'm making 15%, and it's pretty stable, right? Like between 16 and 14%, right? That's your variability around your return. So
Gotcha.
that's your average, and that's your variabilities, right? That's the standard deviation around this return. Here, we have a very high standard deviation. Now, this doesn't mean there can't be a catastrophic event. He could,
absolutely,
let's say, he could take catch up, and somebody could get sick and sue the store, and he'll go below, for $10,000. So he'll buy, $500 worth of ketchup. Somebody gets sick, somebody slips on it, somebody spills ketchup, slips on it. That's going to happen, right? His solution isn't to blame. He just has to keep going, right?
Yep.
He has to make that up in good, in profits and good decisions.
Yep.
But now he's got, more statistics to help him out. He's got the average return here. He's got the variability, and then he's got the frequency of wins. So over here, we could see, like, on the hamburger side, right? He only made he was only profitable 2 out of 4 times, 50%. Right. That's all. The other part, one was break even, one was a loss. Here, actually, it's also 50%. well, actually, here, I'm sorry, it's 100%. It was all profitable, right? They were all positive. He made 14%, 16%, 14%, 16%, but there was no negative, right? So that's more statistics that's helping him manage all that risk, right? Manage and tweak all this risk that he's carrying, right? And that's how, when we look at the historical, right? Well, here are all the different stocks here, historically, all the different stocks around earnings, right? So these are stocks around earnings, just like his event, and these are different strategy types that you could do. You could be short a 25 delta call, or you could do a debit call spread where you could buy one call, sell one call, and you're measuring historically, how did they do? How often were they profitable? What was the average return on them? What was the median return? What was the high and low? So you could kind of get a range. This is to these 12 quarters. You're limiting to these last 12 quarters, but now you're getting an analysis, the standard deviation, and then we have this, what we call the Sharpe ratio, where we divide the average return by the standard deviation of these returns. Right. So you're taking the standard deviation of all these returns and dividing it by the average of the returns.
Yep. Now, just so, I mean, you beginner traders out there, you will see win rates of 100%. You see those all the time, but this is a lot like the catch-up. Past performance does not equal future results, right? So you have to.
Exactly. Right. So he doesn't know, right, if this 4th of July, if these catch-ups won't be a disaster. Like I said, he could buy $500 worth of ketchup, nobody buys it, right? Nobody comes in. Or he spills the ketchup and he's got a lawsuit, or whatever it is, he still has risk, right? But he's letting the data over time drive his decisions, right? Because then at least you're making sensible business decisions.
Right.
Otherwise, you're managing this whole thing, and what are you going to do? You could look at the last 3 weeks and say, oh, they're apples are on demand, and fill your entire store with apples.
Right.
But eventually you're gonna, you're gonna lose that way.
Yep.
So that's that's what's going on over here. We're looking at, okay, maybe we're just interested in a certain type of strategy, right? Like we're looking at long at the money straddle. We want to see where do we have 70% winners? Where do we have average returns, above 10%? Where did we have a median return above 10%? And this starts filtering out for us historically what worked, right? Because if you don't know, you're just looking at an options change, so you don't even know, like, well, what worked in the past? Where should I even begin my research? So you could look by strategy, you could look by stock symbols, and also you could just take a look at what's actionable today. What should I be looking at today?
Right.
So on any strategy that fit these criteria. So besides that, we also look at the potential timeframes. Not only the strategy, but when is the entry and exit points, do they matter, right? So let's take a look at Trader Joe, and let's say he's looking at these fruits and he's looking at the apples, right? And he knows that maybe if I buy these apples on Friday, right, and and I sell them out, probably by Sunday, my return on these apples is like, I don't know, 15%, right? But if I do it on Monday, if I buy them on Monday, and I sell them out by Friday, my return is 5%, right? Because maybe on Saturday and Sunday, that's where you get the most demand.
Sure.
And because of that, you want to make sure that on Friday, you're buying your apples, so you could capitalize on that margin. Monday through Friday, it's not so well. But so right now, just notice that these statistics, we're not talking about price. We're just looking at what are your return from your purchase price to your selling price, right? Like, what is the spread in your return from one period to another?
Yep.
So if you look at this doesn't mean that on Friday, apples are the cheapest price, right? They could very well be the cheapest. If he goes to the farm, Monday might be the best deals for him, right? But even though he's getting Monday the best deals, it's very tough to make this 15% margin, because he's also not able to charge the same margin.
Yep.
So here, from Friday to Sunday, what this is telling him is that the returns, the spread, right, his margin was the highest.
Yep.
Okay.
This has to do a little bit with for you newbies out there, this idea of, I buy stocks because they're cheap. That's kind of a little bit of what Dmitry's talking about here. Is just because the stock's $5 doesn't mean you're going to make more money on a $5 stock, because you can buy, if you have $100, it might be a better return on investment to buy $100 stock rather than $25 stocks, if you know what I mean.
Right. And the idea here is what we're analyzing is, we know we have an event coming up. So it's very possible that historically the best time, it was like sell a straddle before the event, buy back the day after, because the volatility gets crushed. Maybe that's not the best. Maybe you wanted to ride the implied volatility by buying it before the event and selling it right before the event, right? Because then you're playing the run up in the implied volatility, or you play it after. But what this is telling you is, historically, not only was this when the strategy, but the returns, right? When were the returns, and how frequent were the returns, based on, if you started the strategy 2 weeks before and 1 day after, 3 days before day of earnings. So these are statistics to start helping you, form your strategies.
Does everybody understand what Dmitry's pointing to there, as far as like when you buy, when you sell? Does everybody get that? Just want to make sure. Want to make sure that people understand what you're scrolling over there, and just, that you're buying it 3 days before, you're selling it day of earnings, whatever it may be.
Right. Yep. Right. And that's the time frame. Just like Trader Joe might, when should I start buying the apples? Because they're going to expire, right? The apples are, he can't just buy them and sit on them forever. He's got to sell them, or they're going to go bad, right?
Yep.
Same thing with a lot of this stuff. So that these are the things that he's probably, and I've never worked at a supermarket, but as I'm walking through it, I'm
I've worked at a
imagining,
supermarket.
yeah, even the way they place, right? Even the way they
Absolutely.
place this all gets analyzed, right?
Yep.
This goes through the cashier into a data bank and gets analyzed. Because this here, when you look at it, it's logistics. It's very hard. If you get this wrong, you know, you've got a lot of inventory that might just go bad and you lose, right? And this operation is not cheap.
Yep.
You have to get this right.
I mean, I've heard it
Just
before from back in my old business days. It was like I was joking about the milk, but that's true. They put the milk in the most far away point in the store because milk is the #1 product they sell, basically, as far as volume goes. So X percentage of people who come into the store are looking for milk. So it's like the highest of all the percentage. So they put that in the back corner, so you have to pass a bunch of stuff on your way to the milk, right? So
exactly. And that was probably data driven, right? They did a test on it and figured that once they do that, their overall purchases go up, right? Because they're forced to walk past the other stuff.
Yep.
Okay. And so this is what here is, and you could see these are over 2 million back tests, right? All ready for you, right? So that data is there ready for you to analyze. Now, remember, we talked about statistics. This doesn't mean that there's no news coming out of them. This is already what happened, right? This is what happened, and it's giving you some analysis, some data to start considering in your decision making. And another thing is, you don't want to just pick one and say, whoa, this one looks great, I'm going to do this one, and if this one works out, because then what are you violating, right? You're violating this. You're not, your risk is not diversified. It's not evenly distributed, right? So if you have a catastrophic, especially during like a catastrophic risk, you if you're buying and selling, there's going to be times when you own a call and the stock just jumps, gets taken over, has good news, or you're selling the put, and there's going to be times where the next day, the SEC says something, the FDA says something, the company says something, and it's going to go against you. You're not going to be on the right side of news every time. Over time, they should offset, right? They should, you should be on the right side as many times as you're on the wrong side over time. So that's how, these are the different strategies. These are the statistics for you. So you could even, look, if you want to see, well, what is a Sharpe ratio, which is basically taking the average return, dividing it by the standard deviation of these returns. Remember, you're only looking at this data set, right? It's not going to tell you the next move. It's just analyzing the data set. Then you get this Sharpe ratio. So the higher it is, the better theoretically it is, because you're getting higher average return for less variability around that average. So, and the next thing right here, what we just did around the calendar, we did today's opportunities. And here I split it up, defined risk and undefined risk. This is all. So these are like things that are potentially actionable today, and these would be the times you take them off. So here's like a strategy here. This is the week before, one day after. This is in the last 12 quarters what happened. This is the average return and Sharpe ratio. And when we look here, we divided it into defined risk and undefined. So when you have defined risk, you kind of know, well, if I bought an option for $1 and it went up 20 cents, my risk was $1. I made 20 cents. It's 20% return. All right. Even in a call spread, your max, you pay $2 for a call, $5 call spread, you're risking $2. So you could kind of, your average return on your risk. Undefined risk is something where, you don't have a limit to the risk. If you sell a call or you sell a put, there's no limit. So we don't, theoretically, it could be infinity, but that's not realistic. So you start trying to say, well, what do I think my risks are? So the undefined risk is a little bit trickier, and that's where you get into. So we'll like pop something open like this, like short 25 delta in BA. And again, if there's news in it, you got to take that into consideration because, like healthcare stocks right now, besides earnings, there's a different event going on, right? There's news coming out every day, especially like, they want it more government controlled, and the CEOs are saying that would be disastrous for it. So now it's a completely different event on top of the news. And what did they say? You don't want to throw against the wind, right? If it's going one way, you don't want to bet against it. You just skip it and go to something different. But over here, like, let's just take a look at, these puts, and historically, you sold the puts right after, this is before and after. So this was profitable. But what was your risk, right? You don't know what your risk was when you sold the put. It's certainly, the risk is greater than what you sold the put for, right? If you sell put for $1, it could be 5, 3, you don't know it. So you kind of start running it through tests, right? You try to say, well, reasonably, what do I think my risk is? So what is my amount of risk? And you kind of have to, theoretically say, well, what if it was down 10%? If this stock was 10% down 10%, my risk was, at this stage, I would have lost $19.50. What if it moved a 3 standard deviation move? This is my risk. Historically, what if it moved the maximum move it did in the last 10 years? This is my risk. So then you kind of, this is tricky, right? This is tricky when you don't know your risk ahead of time. So you start going through scenarios like, what do I think my risk is? Right now we have it set at, the maximum risk in the last 10 years. We just set it right now to be the most conservative. So that's another thing when you're looking at undefined risk. You don't really know what your risk is ahead of time.
Sure.
Right? You have to estimate it. Here we go to the defined risk. Here we kind of know, well, okay, the credit call spread. If I sold this 50 delta call, bought the 25 delta call, I know my risk, right? So you could just see like the 55, 57.5 call spread. So the most it will be worth is $2.50 minus like the 77 credit that you would receive. So you know your risk ahead of time, and you kind of can calculate your return on the amount at risk. So that's what's going on over here.
Yep.
Now, once we get to this point, right? Once we get to this point and say, okay, historically,
can I cut you off for a sec there, Dmitry? I just want to point out to people who are new to the platform, under the historical strategy backtest results, the number of OBS, that's observations. Okay, so just so you guys know, those are 12 observations. So just to
those are 12
observations.
Don't know right. Right. And you could click on there and just see what happened, right? Like in the last 12 earnings quarters, these were the returns, on your risk. That's what happened. So on average, it was 13.3%. This the medium. This was the highest, the worst. So you had a loss over there, standard deviation. So that's the last 12 quarters. You could kind of even open it up and take a look at the options chain.
Yep.
Now that we know this, remember we didn't talk about prices yet, right? So we don't know what the current price of this strategy is. We just know historically, from one period to the next, these were the returns.
Right.
So let's just come back here. What we did was we calculated. Did I do it on here? Let me just come here, right? So we calculated that from one period to the next, it was from 5% to 15%, right? That's what we know, but we don't know, well, how does today's price measure up, right? So we don't know that. We don't know how, so let's just clear this. I'm gonna clear this out. For some reason, my delete's not working. Let's pretend it's like apples, right? And we know that, I think we said that we buy apples on Friday, right?
Right.
Sell on Sunday. And let's say today's price is $6, right? Is that a good price, right? That's the next step. Well, we see historically how things perform, but this doesn't tell us, is today's price fair? What if today's price is so high that it doesn't matter,
Right.
what these are? You're not going to pay $1 million for an apple and expect this, right? It's not going to happen. So then you want to kind of test the price out. Well, so today's price, you go to the farm, it's $6. Well, then you kind of want to see, like, historically, if I bought them on Friday, by the time I sold them, all right, let's say your analytics say, well, 50% of the time, I don't know why this disappears every time. 50% of the time, I get $8, right? My selling price is $8 on average.
Right.
25% of the time, it's, let's say, $6, right? Another 25% of the time, my average price is $4. So about 25% of the time, I lose money. If I buy it for $6, historically, 25% of the time, by the time I sold out of my basket of apples, I got $4 back.
Right.
You have to discount them until you get it back. 25%, I got $6, and 50% of the time, it's going to work out. It's $8. So here on average, $6 works out, but it's also telling me, well, how frequently, did it work out? And on average, how much did I sell and what my low and high prices? So that's the next step, right? You're like, okay, this worked historically, and let's just take like maybe a call here at the money call, right? In Intel, and right now it's $1.39.
Mm-hmm.
So how do I evaluate that? Now, this is a different analysis, right? This analysis is done now. I have to evaluate this price, right? How is this price? Is it a good price? Is it a fair price? Is it too high or too low? Because I still need to know. So this is kind of like, this is the theoretical value. And this is saying that, well, if it's worth theoretically at 180 over a long period of time, then $1.39 should be, a decent price. But let's go analyze it, right? This is just a top number. So we'll go to so I'm going to click on this, and it's going to pick that option. So it just set that option for me in the 58.5, right? This is how it looks at expiration, right? This option. So let's test it out. I'm going to pick out a different time frame. I'm not going to do 12 quarters, but I'm going to look at the last 10 years. And this is going to look at only earnings periods. And we're going to see, this is the market right now, right? This is the market. If we bought it here, how well would we do? So what this is saying is, in the last 10 years, if we did this similar trade, right, with the strike this far away, the same distance from the stock price, with an earnings and the same expiration as right now, right? We looked at the price history distribution. On average, what would the option be worth, right? So over here, from this date to this date, the stock dropped 3%. Well, theoretically, right now, that would make the stock at expiration worth $56.87. This option is worthless. On this date, it was up 3.8%. Theoretically, this is what the stock would be worth at expiration. So this is what the option would be worth at expiration. And it's going through each scenario using the price history, 39 observations. So you could see here the highest, if it replicated the highest return in the last 10 years, going down the line, and tells you this was
just so you saw that, guy. If you missed that quick move, when you click on the top there, it sorts just like an Excel sheet would sort, high to low, low to high. As you can toggle between the two.
Yep.
Yep.
So this is telling you, well, at $1.36, remember, just like our apples, right? Did I lose the apple? Just like our apples, for $6, right? If we did it for $6, we would have made money 50% of the time historically, right? Based on our selling prices.
Yep.
That's what this is saying, that if you bought it at if you bought this at $1.36 with the same, with the similar situation, using historical price returns, using the returns, you would have been profitable 46% of the time. and here on average, what this is saying, if you take the average of this, what's it like, 5 and 8, so you'd have made a little bit of money, right? So what's that, 13 divided by 2, $6.50. So so it's a fair price, I guess, on average, right? Because you don't know what you're going to hit here. But certainly if you're paying $10 based on these statistics, that's not good, right? Unless you have reason to believe you could get more, right? If maybe, I don't know, there's a report and everybody's buying apples and you see other stores selling them, then maybe. But if this is all the information you have, right, that's kind of like where you're going. Well, he's selling, according to my data, it's either too high, too low, or it's fair.
Yep.
Does that make sense?
Yeah, totally. Actually, are you ready to get to some questions? I know this is a lot of stuff and you could probably keep going. You ready to do some questions?
Yeah, so I can't see any, I only see my screen. Should I jump back?
Yeah, you can go to, well, you can't go back to the picture-in-picture screen. I could read them to you. How's that sound? That way you can keep the chameleon up. And if you want to show anything, you can do it.
Okay.
So first one from Zaid, I think. How do you avoid big losses on naked option strategies during earnings? I don't like trading strategies like iron condors because they limit the profit potential considerably, and they're not quote unquote fun. Dude, you got to be careful, man. This isn't about fun. This is about making money. He says, I had a very painful experience with naked option strategies during earnings. Thanks.
Right. So here, getting back to this, you're not going to avoid. It's about profits and losses. Losses are unavoidable, right? You're not going to be able, there's no way for anybody to say stop, right? Your only protection is you're doing a spread, right? Because a spread already has a stop loss in it. And think about it this way: what is your return on the money you think you're risking, right? Not just because people will sell options without because they look juicy and ooh, I'm getting like $3, right? But they're not considering well, what do you think you're risking, right? What do you think you're risking to make that $3? With a call spread, what you're risking. You know what your max risk is.
I think that's the way probably you want to go, Zaid, is stick to things where you understand the complete risk, where you can understand the potential loss, and you have to be able to be comfortable with that loss. I think Will was saying earlier on another show we did, hey, if you are bothered by it, it's going to cause you loss of sleep. Do not make that trade. Right. That's our recommendation with that.
And what's interesting, this is a common question, how to avoid, and this is what happens. People look at profits. I don't know, you could go back and look at losses, and then they think my job is to avoid, right? This is because they get, when you don't run a business, you think that losses are completely avoidable, right?
No.
But it's not, the losses are not avoidable, right? You have to manage that your profits exceed your losses.
That's all.
Right.
It's that simple, guys. It's easy.
This comes up a lot. It's a question. Yeah, it's a question that comes up a lot. How do I just? I just want to eliminate losses, but
no, you just got to minimize.
Trader Joe. Yeah, it's like Trader Joe. Do you think he never has milk that spoils? He doesn't have like problems. He doesn't have losing. He doesn't have to throw
inventory breakage, all that stuff. It happens.
It's you can't, if you're you're in a business, right? You're in a business of risk, but you're in a business. Business is not about getting a paycheck at the end. It's managing profits and losses. Nobody's guaranteeing you any paychecks. When you go to, if you work for somebody, I could understand it, right? You could do a bad job, but you're guaranteed a paycheck, right? You could be sick for a whole week. You're guaranteed, you're probably going to get a paycheck. But trading and in a business, it's about managing profits and losses. Not, you can't eliminate them. They're not, there's no such thing. It doesn't exist for anybody. It doesn't exist for the,
best trader in the world is losing money. Absolutely.
Best traders in the Warren Buffett's, Goldman Sachs. You saw two firms that, and it probably been even more, that were in business for 100 years. This is their Lehman Brothers and Bear Stearns went out of business very quickly because they didn't manage. They
didn't
thought,
manage their
well,
risk
I'm
well.
not going to ever lose on this trade, right? I'm
Yep.
just going to sell this, so you shouldn't. You have to control that risk. You have to be prepared to say, if I'm doing this trade, what do I think I'm risking, and be prepared. That's why you want to manage it, right? That's why.
Awesome.
That's why when you're in this store, right? How is he managing this risk? Trader Joe is not loading up on watermelons, right?
No,
He's not loading up.
Diversify.
Yeah, exactly. You want to be diversified and very small, right? You don't.
Yep.
If you're in a situation where, oh my God, I lost. You did one trade, and oh my God, I lost so much money, and you're nervous. You did it too much, and you did it wrong. You didn't manage
Should have
your
never
risk.
done that trade. That's right.
Yeah,
Yep.
yeah.
All right, let's get to the next one. It's John. He says it's a question about the platform. He says, do you guys plan on including a butterfly slash condor slash calendar slash diagonal scanners potentially in the future? I'm loving your spread scanners so far. Thanks for the compliment, John. I'll leave it to Dmitry if we got any of those plans in the works.
Thanks. So I think he's referring, we do have him for the earnings, but I think he might be saying, we have the credit spreads, and recall we have all these screeners.
Sure.
And it's something, I think over time, it's something that we will probably be adding. We're working on some other projects right now, but I think that we will be adding them, especially maybe once we feel like we're kind of done with these, because we do take feedback and we look at, how we could improve these, and whatever we do with these spreads, will then be the model for our next screeners. Yeah, but thank you for the questions. We do have them.
Nice.
We do have them though for the earnings.
We're always working on new projects. I mean, if you guys were watching the options report, I don't know, 4 months ago or whatever, Will used to use his, you could go look at those old versions, and a lot of the stuff we were using there wasn't even on the site yet. Will was actually giving everybody a look at the beta. So we're constantly adding new stuff, but good question there. The next one is from Benai. Excuse me if I'm pronouncing it wrong. Aren't straddles volatility plays? He asks. The volatility is so low nowadays that my recent straddles have pretty much, I guess, losing money. So,
right. So, when you're buying a straddle, there's only two ways to make money. It's either the stock is going to move, right? The stock has to move, or the implied volatility has to increase. But that is your risk, right? That's it. When you're buying a straddle, that's your risk. If implied volatility comes in or the stock doesn't move, the straddle will lose money.
Yep. Our good friend Mike's came up. He says, excellent job.
Cool.
Thanks, Mike. What are your thoughts of a strong seasonal finding that conflicts with earning findings? Do you favor one over the other, or just move on to the next trade?
Yeah. So there's going to be times when you have statistics that are going to conflict. You're just using them as tools to help you out. And you kind of have to, if anybody ever used, I go to like Google Analytics, you could have like one really good stat and like one really bad stat, and like one saying this and one saying that. So you're trying to kind of they're tools to help you manage your decision making. And sometimes they're not even telling, like, how they take stats when who are you going to vote for, right? They take like 100 people and they say, well, 53% of the people said that this candidate's going to win, right? But then it doesn't happen that way. They lose because they don't know. First of all, they don't know how everybody you can't predict, right? The stat won't predict the actual event. They don't know how all the people, when they vote, how they're going to vote. Another thing, the stat might say today, 53% of the people are voting for this candidate, but then the next day, something comes out where the candidate was like, guilty of something, right? Then the next day, 70% are voting for the other candidate. So you can't say, well, that stat was wrong because the stat didn't even include the new news, right? So that 53%, the people who were voting didn't even know about it.
Absolutely.
So you're kind of using it as guidance, but they're not perfect
Yeah,
because
no
tomorrow
stat encompasses all data, right?
it doesn't encompass all data or
Or the
information.
future. I mean, it's impossible. It's literally,
Yeah,
yeah.
yeah, and it's not going to predict. It's not going to predict news that nobody even knows about, right?
Yep.
It doesn't know that. It's just trying to help you, guide you to better decisions. Guide you to make, just like Trader Joe, he's being guided by this data analysis. Where should I increase prices? This isn't selling. I have a lot in inventory. Don't buy it. Where should I decrease prices to reduce it?
Yep.
He's managed. This data is always being analyzed and is driving the decisions, right? He's not just guessing, right? He's using the data from the cashier to drive these decisions, or he's going to go out of business because
Right. Or it's just all by the gut. And if you run your business all by the gut, you're definitely going out of business.
you're going to go out. You're going to go out of business. So you need some kind of guidance to help you out, and that's
Well, can
most.
you on that kick? Can you answer this one for Benai? He's asking about the theoretical edge column, and what does
Yeah,
that indicate? Just go over
this
that real briefly for him.
this theoretical edge. So
Yep.
the theoretical edge over
Yeah.
here. So what it's indicating is, some of these strategies are buying, some are selling, right? So right now, this is the market in this strategy, and it's comparing the market price to the theoretical long-term value. Remember when we went over and did all of our data, theoretically, if you kept doing this trade over and over and over again with the same distance to the strikes and the same days to expiration with the same earnings in between the expiration, this would have been worth $1.17 over the long term. Right now it's 98 cents. So theoretically, because you're buying this, it's a long debit spread. Theoretically, it's like 19 cents below the long-term average,
Yep.
right? The long-term average is $1.17. Right now, it's 19 cents below. So a positive theoretical edge is saying it's in your favor, right? So credit spread here, you're selling, right? So since you're selling for 435, the long-term average is 313. Well, that's a positive theoretical because you're selling above a value, right? You want to sell above and buy below, right?
Yep.
A long-term theoretical value.
Cool. Awesome.
Yeah.
Hey, while we're I just was texting in the text box. There's my email. If you guys have any questions for me about the product or whatever, there's my email in the chat. You guys can hit me up. And since I'm here and I got the Chameleon cups, if you guys watch our morning show, Chameleon cups are a thing. And if anybody tries out the offer today, which is the 7-day free trial, if you click on that while we're on and sign up for it within about 20, I'll give you 30 minutes after the show. Shoot me an email, say, hey, I signed up, and give me my Chameleon cup, and I'll ship one out to you as long as you are in the continental US of A. So there's a little offer for you guys. So Mike's got another question. He's saying on diversification and multiple small trade ideas. For any given earnings event, do you like the idea of choosing multiple structures for the same event or multiple time frames, like before, during, and after? Or do you do both?
Well, I think you want to spread out your risk as much as possible. So you might want to even do different stocks.
That's it's more diverse
So
if you're doing different rather than
yeah,
the
you want
time
to
frame, right?
diversify, right? Because think like Trader Joe. Like I always go like, how would I Trader Joe? Should he diversify in different types of milk or
Right.
diversify
Yeah.
between
It's
milk
right. It's all in the same kind of silo, right?
Yeah, exactly. Yeah. So you don't want to have like 100 different pastas. You kind of want to diversify as much as you can, because some things are going to lose here, some things are going to make here, right? The profits should exceed the losses if you're managing it right. But not all of this when you run a business, I think maybe some people are under assumption every time that everything here you make 100% profit, but businesses don't run that way.
Not at all.
Yeah, if you go to a restaurant, they're going to be, they overbuy food, right?
Yep.
They're going to have to waste, or there's going to be dishes that are broken, or there's going to be, so there's always going to be profits and losses. You just want your profits to exceed your losses. And certainly diversification and distributing your risk evenly is oh, sorry, where did I come back here? Right. So you probably want to diversify in different stocks too,
Yeah.
right? And and
Different
also
stocks, different
and
sectors, all these sort of things.
even different sectors, right? Because you don't want to be, you know, you don't want to, like, for example, right now you don't want to be selling put spreads in only healthcare stocks, because now you're exposed, right, to a downside move in the sector. Um, so you do want to kind of diversify as much as you can and make them small.
Great. Mike's also got another one. He's saying he's always been hesitant to try a risk reversal or even a hedge limited risk reversal for earnings
Mhm.
because of fear of loss and no real data. But since Will
Yeah,
loves these structures, does he
right.
feel they have a role in earnings trades? Conceptually, we risk big moves, but we also have vol collapse on short and big upside on long, if correct.
Yeah. The risk reversals, they're tricky, and I'll take a look at one like an SPY. These risk reversals, a lot of times why people like them is, because of the skew, right? So you're like buying an upside call for a cheaper vol and you're selling a downside put for a higher volatility, right? So you're kind of like, on a relative basis, this is cheaper than this. So you're selling one, buying the other. But yeah, your risk is is completely to the downside. Your risk is if the stock goes down, then your risk is, you're short a put,
Yep.
and the implied volatility is going to go up, and um so that's why the risk reversal though is set up that way for the downside shock.
Yep.
um and if you're not ready for that, then yeah, you shouldn't do that. Sometimes though, if you just feel, it depends on like what you think the stock might do, right? Like what you think the stock might do. So sometimes, doing one risk reversal might not be like a bad idea depending on your outlook on the stock, right? Because you could maybe potentially, if you think the stock's going to either go up dramatically or just kind of maybe sit in between, and you buy this call and finance it with this put, you receive a little bit of money.
Yep.
And if it just sits there, you'll get it. If not, if it goes up, you'll make money. But yeah, your risk is you have a much higher risk to the downside
Sure.
with the
Yeah, Will
reversal.
does tend to love that strategy.
Uh, yeah, it
Maybe
was a
that's the reason he doesn't have an indoor pool yet. I don't know. We're still debating
yeah.
that.
Well, market makers who are hedging and trading around it, used to be a popular strategy
Yep.
actually, to do risk reversals. And they would manage their deltas and buy things against it, sell it. But it was a popular strategy. I mean, it's like anything, right? You want to, like what we were talking about, even if you do it, you don't want to overweight it, right?
Absolutely.
There's going to be times the risk reversal is going to work amazingly for you, and there's going to be times it might be disastrous for you. But if you're doing it at good prices and sensible prices, you know, you should be making that theoretical edge in between, the statistics that, because really, what are you looking for? You're just looking to have more profits than losses.
Yep. Banai's got another question. He says, how effective or recommended is the strategy to manage the risk on a naked short option by shorting / purchasing the underlying in aftermarket immediately after earnings if the strike is going to be tested? I ask because the volumes are relatively low and the stock bounces around a lot at that time.
All right. Yeah. So the question is, well, if you short a put and the stock is going down, should I hedge the delta risk, right,
Mm-hmm.
with the stock? So if it continues to go down, the put's going to keep losing. So should I short the stock to protect that delta risk? And like professional traders, that's what they do. They're always, trying to manage the risk, and a lot of times they're delta neutral. Actually, they're just trading the volatility. Of course, there's no right answer, because you could sell the stock in after hours, and the next day it could be a very bad sale, or you could sell the stock in after hours, and it's much lower the next day. It could be a good one. So I don't I don't think there's a one size fits all, and there's no way of knowing what the stock is going to do the next day. But usually the stocks are very liquid in the aftermarkets. So you do have more, illiquidity risk. They're not as fairly priced, and they're not, the markets are wider. They're very liquid. So you got to take that into consideration.
Yep. Be careful out there, Benai.
The
Be
best thing
careful.
to do, if you're selling a put, and if you're selling a put and you feel like if something is going to go wrong, I need to protect. If you're in that situation, you should be doing a put spread, right? So you're not in a situation where, like, I need to do something when it's already too late to
You're
do
scrambling.
something, right? You shouldn't. Yeah, you should. Right. You should know this ahead of time, or just be prepared. Like, I'm ready to take. Even if the stock's down 30%, I'm ready to take that hit. It doesn't affect.
Right.
It doesn't affect here my overall price. I could take these fruits and I lose all $500 on these fruits. It's fine.
Yeah,
I'm
you
going to
don't
make
feel
it up
great
over
about it,
time.
but
And
this is part of the deal. You understand it's part of the deal.
yeah, it's part of the deal, right? Because if you feel like, if I buy $5,000 worth of fruits and, oh my God, I'm not selling them, or I have to lower the price,
Yeah,
you overdid it.
absolutely.
You took too much risk. You gotta before you even get in a trade, you got to think about what is going to, what am I going to do if I can't accept that risk?
It's the one time I
then I
think gut
shouldn't.
is actually a good point, where if your gut is telling you, ooh, that's going to really, make me not feel great, don't even do the trade, right?
Yeah. Yeah, don't do the trade. Just go
Yep.
to a different trade. Look, the market itself is not going to close. There's not going to be a lack of opportunities, and people aren't going to stop
That's
making
right.
money. You just find a, make sure that you're managing that your risk is in line, in proportion to what you can
Exactly.
risk.
Joe Cook, thanks for joining us, Joe. Joe
Mhm.
says, during earnings, when's the best time to sell or buy strangles in low or high implied volatility?
Yes. Well, my best answer is, the only thing I could do is look at
Mm-hmm.
data, right? And I could go over here and take a look at which stocks. And what did he say? Selling straddles or buying
When
straddles,
he's
or
saying either or, so buy or sell strangles.
okay, so strangles. So you could go over here and let's just take a look. On the 25 delta strangle. It's in here somewhere. So here's a strangle, right? So I'm just filtering out strangles, and over here, these are the time frames. These were the win rates. These were the average returns. So let's just take a look at higher market cap
So I guess
stocks
he's kind of asking,
with
is it in low or high implied volatility?
uh, not
Well,
the
he's saying
time
during
frame
earnings.
before earnings.
When's the best time to sell buy strangles? And then he says dot 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 in low or high IV.
Right. Okay, so that's a little
Yeah.
bit different. If you were just looking at time frame, this is what this would be doing. But when you're looking at a straddle before earnings, the implied volatility itself is a little bit deceiving, because the way the Black-Scholes model works is it doesn't take into consideration a one-day
Mhm.
gap. The implied volatility thinks that the price of the option is evenly distributed. On average, it's taking average volatility through the lifespan of how many days there are left to expiration. So this implied volatility is a little bit
Right.
deceiving. One way to do it is you could put up a straddle like this, right? Here's a straddle. This is what it's worth. This is what it's worth today, right? 260, right? The midpoint's 258. Historically, over the last 10 years, only earnings periods, what do you think on average it was worth? And that's one way to compare, because then you're taking into consideration the entire
Yep.
move, right? The entire move of the earnings period. The implied volatility won't tell you, it doesn't tell you that much, as far as like the gap
Yep.
risk.
Good. I hope that answers that for you, Joe. Tom asks, is not 12 observations too small a number? Markets last not only 3 years to grow. He says, I use at least data from the last 10 years.
Right. So right here, I did when I did this straddle, I looked at like a 10-year, you could, let me see. Over here, you have the ability to change the years to 10 years, or, you could go, 237. This was your win rate over 10 years. You could see how consistent it was, like over 5 years, 3 years. And the question comes up, well, how much data should you use? Like what is the data set? How far back
Right.
you should go? And there's no
There's no perfect answer for
like
that, is there?
right answer.
Going back to
There's
the
no
beginning of
perfect
time
answer.
is not necessarily the best idea, right?
Right. Exactly. Going to the beginning of time, it's not the best idea. And you want to kind of stay as you go back further and further in data. Remember, because this data, it's not like you don't have 100 data sets. It's different if you had 100 data sets that were more relevant in today's time period. You're going back 10 years. So 10 years ago, for example, the earnings, a lot of these stocks looked a lot
Sure.
differently. Even 5 years, 6, like, GE probably had a different makeup of, companies 10 years ago,
Absolutely.
and a lot of stocks, even like Facebook, I don't know, like when they started acquiring companies, their revenues look different today. And on top of that, as as you get closer and closer, right, as time goes on, you have more analysts covering them, you have more information flowing that more liquidity providers, more research on them, that the tendency of the movements could also change. So how it moved 10 years ago, not even about the company, like 10 years ago or 15 years ago, we didn't even, people weren't even, they didn't even have
Yeah.
information over the internet. I think when I started out, people were not even able to enter trades electronically. They were calling their broker, so there's
Sure.
more liquidity now. There's interest rates. So, when you use the data, you could look, you could look back, you could keep looking back and back. Like think about it in a car insurance company, right? If they did like 50 years back worth of data, well, 50 years ago, the
Yeah, they
cars
were
looked different, right?
garbage,
The roads
no
were
seatbelt,
good.
no airbag
Yeah,
cars. Yeah, of course.
yeah, yeah. So unfortunately, what you do like 12, that's 4 years of data, but um, or 3 years of data, but it's how far you have to kind of see like what
Right.
is the most relevant data, like you, that you want to put
That's a
into
good
your
answer, boy.
analysis.
Hey,
Yeah.
Tony's asking about links to the video. Everybody who's joining us now and anybody who's even registered will get an email from me with links to watch the video after. But it does only last for like 3 days after because that's just a server thing. So you got to watch it within a 3-day window. Thanks, Tony, for joining us. Appreciate that. Of Dimitri's earnings related trades, what structure do you use most
Mhm.
often? Do you have any favorites, or do you have any specifically that you avoid?
Earnings
Trades, yeah.
related trades. Uh,
There are any of those that
well,
just, I mean, I
like
think
for
he's
me,
probably getting into just the ones you're like, oh, I never do those ones.
yeah, no, I mean, I evaluate them differently. I don't think I have a favorite one, but I do probably. I'm more of a conservative. Not
Hmm.
everybody is. I'm more of a conservative. So I just like to. I if I'm selling, I want to buy something against it. If I'm buying, maybe I want to sell something against it. Like really, the simplest thing is just do. You could do like vertical spreads. Or people do butterflies, but I've always come from, as a market maker, I was always buying and selling. I was always managing risk, so I didn't like too much exposure
Right.
one way or the other.
Well, with that, he's saying,
So
can you show on the site how to find and capture after earning opportunities?
like yeah, so like for example, if you wanted to do a historical open range, like say one
There you
day
go.
after
Hmm.
earnings, right? Something like that. So you could kind of like see, well, what we could do by win rate. Let's see that. So here you go, like here's like one day after earnings, 2 days after earnings, one day, 3 days. So, some of them, as you could see, the time to sell was probably after earnings. You still had opportunities to, let's do by average return. So even here after earnings, there's a big move here.
Right.
Let's take a look
There you
this
go.
way. So you could kind of see possible opportunities even
Awesome.
after earnings. Again, like this is just kind of to get you started, right? It's a starting point. You still want to go look, well,
Yep.
what's going on, right? If they had bad earnings and if they're saying something terrible, you probably then don't want to throw against the wind.
Hey, Mike, thanks for that.
Yeah.
Thanks for the great questions, everybody. Really good questions. I think we dove pretty deep there.
Yeah.
And we had a lot of
Thanks, guys.
people who are just starting. Over half of our people here would consider themselves beginners. So thanks for everybody for clicking on that poll. Again, the offer's there. You will get the email, everybody. Everybody's going to get the email after the webinar, probably about an hour or two afterwards. The email will come to you where you guys can watch the webinar again. It actually has really, really nice, those questions we just answered. You might have heard me clicking. It actually has links to all those answers. So you don't have to watch the whole thing. You can skip around, click on those links. The webinar, software will take you immediately to those answers. So super, super nice. If you guys missed anything or whatever, you can jump around real quick and find those answers again. Thank you so much for having us, everybody. Thanks for tuning in. Remember,
Thanks,
if you're
guys.
new to the Chameleon, do click that offer tab. It's a 7-day free trial. You can try out the Chameleon free for 7 days. Make sure it fits in your trading model. Make sure you're comfortable with it. And Dmitry, thanks so much, my man.
Thanks, Adam.
Thanks everybody for
Bye,
joining
guys.
us. Have a great day. Have a great holiday weekend. And we'll see you all Monday for the option report. Later.
Bye, guys.